In this video here, we're going to look at the battle between two popular momentum indicators, the ADX and the Commodity Channel Index, CCI. And which one's better? I'm going to give you a tip right now. There is not one which is better. They're both very useful. So first up, the ADX. This will not show you the direction of the trend. You can see that with price, but it focuses on the strength of the trend. So a high ADX value over 25 signals a stronger trend. Makes it a great tool if you're following the trend with your trades. But you got to note, it's a lagging indicator like the majority of indicators out there, so it's going to react a little bit slower to changes. The CCI, this is about timing. This is going to help you identify when prices are reaching extremes compared to an average level. So values above plus 100 or below minus 100 can indicate overbought or oversold conditions. So this makes it really useful if you're looking for precise entry or exit points in your trades, but it has drawbacks as well. It can produce false signals, right? Everything else can out there as well. So use it with other indicators or price action. And essentially the CCI, nothing special. It just shows you how far from a moving average price has moved. Price stretch will eventually lead to mean reversion. It's a pullback. So in the strategy, you're going to see later, you're going to see where the CCI crosses the zero line. It actually crosses the 20 SMA around the same time. I'm not going to point that out to you. I hope you can see it yourself. Now, CCI, when you use it, can actually free up the price part of your chart. So if you're heavy into price action, you're not going to have squiggly lines in your way. So when it comes to choosing between them, well, it does depend on your trading style and your objectives. If you need a strong trend, look at the ADX. If you're more concerned about timing your trades around price extremes, then the CCI can be used. But combining it, both the CCI and the ADX together, it's going to give you a better view of the market, more comprehensive. So a strong ADX reading combined with a CCI signal confirms not only the strength of the trend, but also the timing of a trade. And then watch for confirmation from price action or any other indicator before you make a trade. So this strategy is going to combine the trend strength measurement of the ADX and our market timing capabilities of the CCI. So we're going to look for strong trends and we're going to look for entry points with our CCI. So for the first thing, we're going to set up our chart. So you got to choose a time frame. It depends on your trading style. So just select a time frame that suits you and what you're available to trade. So if you're able to do day trade, look at a 15 to an hour chart. Swing traders, you can look at a 4-hour chart to a daily chart. Whichever one's going to suit you, best one to use. We're going to put our indicators on. The ADX is going to be set to period 14 and the CCI is 20. Now you can adjust these settings based on whatever market you're using, kind of trades you like to take. These are just some place to start at. So the first thing we want to do is look for a time when the ADX is above 25. So we're looking at an uptrend here. Then we see the ADX above 25. That is a strong uptrend. That's what we want to see. We want to see the CCI pull back underneath the minus 100 line. And we get that right here. Just kind of dips below it. You can see it right here. And then when it comes back above, you would enter your trade. You notice it never tests the low, and that would be the area where your stop loss would go. Do not just take trades because you see it break the minus 100 level. Ensure that you look left and see if you can find a former support level, a resistance level, a swing level, a large wick candle, doesn't matter. So for this one here, just look to the left. We can see that we had a nice little price range here of support. Here was resistance, price broke above, pulled back down. This is your entry here. Stop loss goes just below the swing point. Exits, you can take your exits many different ways. You can trail your stop loss along this moving average here, which you'd get out here, which is a nice, basically 20% run in price. You can target risk to reward ratios. So if you're risking $1, look for $3. Target for scale outs, previous resistance areas, because this is an uptrend. We're looking for resistance. You can scale out portion at this level here and then trail the rest up. There's different ways that you can do everything in trading. Most important thing is make sure you put your stop loss in. This is a very basic approach to trading. You're looking at a trend move. You're looking at a strong trend move. And this is just telling you to pullbacks. That's all we're looking at. Pullbacks into a support zone. This here dips below the zero and then goes back up. So from the standpoint of just playing a conservative, there's no trade there. But you can use these as an add-on trade. So in a strong trend, we're going to get slightly less pullback in time, less pullback in distance in price. So would this one count? Well, again, make sure that you look left and see if you can find an area of price structure. Not very difficult here. You see a consolidation, price broke up, comes back and tests it. That would be a trade. You get into the trade. Once price starts to move back up and the CCI reverses, your entry is here. Your stop, it's quite large. So you'd have to determine what you're comfortable with. You can place your stop on the opposite area of the moving average. That's a viable way to do it. You place your stop around this area here. Again, target whatever you want to target, right? There's nothing cut and dry when it comes to trading. Just do not let winning trades turn into losing trades. Both indicators offer you a really great, unique advantage. And these can be powerful tools in your trading arsenal, as you saw in the strategy. The key is you need to understand your trading needs and how each of these indicators can serve those needs. So experiment with both, with different settings, different conditions in the market, and see which one's going to align best with how you like to trade. But again, remember, there's no best. There's no one-size-fits-all answer in trading. We're all different. But the more you practice, you learn about these types of indicators, the better equipped you're going to be to make trading decisions based on you, no one else.